All right, so as I said, we're doing highlights today, and you have a booklet that I have provided on the significant changes, and you will keep that booklet, I'm sure, on your desk during tax season. There's all the key provisions. Most of this presentation, there's proposed guidance. So I held off in providing you the PowerPoint because I'm again doing a presentation for the Brooklyn Queens chapter of CPAs towards the end of January, and I'm sure there's going to be a little bit of a tweaking of it, and we'll hand the PowerPoint after. Just make sure the email is provided to SCORE and the IAA. So I always like to go into a little history just to refresh you, and I'm sure you heard a lot about this on the news. This act was introduced to the House in early November of 2017, and the reason why I go through some dates is because there's key dates in the act itself. One of the key dates is December 15th of 2017, and that's when it was released into conference committee, and the report was released. It worked its way up December 20th and was signed off, and then went to the president for sign-off December 22nd. So I have a first polling question that I'm just going to throw out there. Just, you think about the answer, but don't shout it out. Congress passed a $1.5 trillion tax cut, and the president signed it into law. So is it the largest structural overhaul of the tax system since 1986? Is it the largest federal tax cut ever enacted? Does it devote 53% of the cuts to the middle class? And does it abolish the corporate income tax? Well, no, it doesn't abolish the corporate income tax, so it's not D. It actually reduces the corporate income tax permanently from 35% to 21%. And it is not the largest federal tax cut ever enacted, but it is the largest structural overhaul of the tax system since 1986. And we're going to try to cover this in the first 90 minutes, as I said, in the PowerPoint presentation. I'm going to go through what is on this slide in detail. Of course, there's individual tax cuts, and there's business tax cuts that we're going to go through. We have also proposals that I want to talk about that finally went into place. What was eliminated, what was limited, so that you know for sure how to apply it during tax season. So of course, the biggest story is that the standard deduction has increased. We know for the married couple, it's $24,000. Head of household is $18,000, and you'll see that in your booklets. And I'm not going to refer to the booklet all the time, but you could actually look through the table of contents to see that. In addition, single taxpayers are $12,000. So of course, what is the concept of this? It's reducing the amount of itemizers, right? We currently have 28% that itemize on their returns. They're hoping that this reduces itemization to about 4%. And that's why they released it a postcard version. It repealed the personal exemptions, but if you notice when you do planning, that larger standard deduction actually includes the repeal of the personal exemption. And even though the repeal of the personal exemption happened, we're going to talk about later that you actually need to use the personal exemption number to determine, as a practitioner and as a taxpayer, the head of household filing status. One other major provision for the married taxpayer is the doubling of the child tax credit. So the child tax credit went from $1,000 for children under the age of 17 to $2,000. And the phase-out increased. So a lot of married couples would get phased out after $110,000. Now it's gone up to $400,000. So you're going to have a lot more of those couples being able to do dollar for dollar. Single taxpayer is $200,000. Another key provision that I highlight here is the individual mandate. The individual mandate is still in place for health care in 2018. And every year here at SCORE, we covered the Affordable Care Act since it came out. This is one of the provisions in 2019 that will no longer apply. And you probably just heard in the news that Texas knocked down the Affordable Care Act, but of course they're going to appeal that decision. And the reason being is because the individual mandate has been eliminated. But what I want you to be aware of when you're doing your 2018 tax returns is that you have to calculate the penalty or determine an exemption. The exemptions, some of them are automatic, others have to be asked from the marketplace. So you need to collect the 1095A forms, the 1095B forms, and the 1095Cs to answer the questions for the individual mandate. And those 1095 forms are going to be required every year after that because the applicable large employer has not been repealed. So that still applies, meaning the companies for the employers have to still issue forms. And so we would have to, as practitioners and taxpayers, figure out the premium tax credit that's provided from the marketplace. And again, some of these exemptions are not available automatically. So you need to request those from the marketplace, which means that, or your taxpayer needs to, you may have to go on extension. So that's just something I want you to be aware of. The penalties are $695 per person on the return if they are not covered for all 12 months, maximum 2.5% of household income, and maxed at $2,085. Some of the other provisions we're going to go through, this is a draft of the form. It actually was released. Leonard just told me that this week the final version looks like it's being released. But this was a postcard version that they provided, just to give you an idea of what it would look like for the standard deduction. And of course, the first page is going to have your generic information, which is the taxpayer information, address, Social Security numbers. And this year, IRS is requesting that you revalidate Social Security numbers. As we know in New York State, we need to do the driver's license information for many of the credits. And the reason why I keep bringing up these credits, because a lot of the credits have stayed, and some of them have expanded. And as practitioners, we need to be aware that there are due diligence requirements that are going to be applied by the IRS. So if one practitioner applied every credit on one return that's available, you can actually incur more than a $40,000 penalty if you don't do your due diligence on all these credits, which is prepare a certification, asking some questions, documentation. So, that's something that I think is more important than just looking at the form, which is your generic information here. The second page of the form on this particular version is a 1, 2, 23. You'll notice they condensed the retirement line on this form, where you have your IRAs, pensions, and annuities all in one line. I thought that was interesting. Usually you have the IRAs and the pensions separated. They're just condensing it. And then on line 8 is your standard deduction. And then, of course, on line 9, we're going to talk about the qualified business income deduction, which many, I'm sure, is very interested in. We have about 10 slides on that. So let's just talk about some of the proposals that ended up staying and what was eliminated and what was the strategy behind it. Of course, the House wanted elimination of most personalized itemized exemptions. And the whole act is based on reducing alternative tax. So that is why they limited the state and local, your real estate taxes all on one line. And we're going to go through a mocked up Schedule A, because those are the items that create alternative minimum tax, which is another tax system that goes on, of course, based on certain add-backs, phase-outs, and exemptions, which we're going to go through. The educational area, they kept all the educational credits. They kept the student loan interest, of course, with certain AGI thresholds, so that some of the students that are coming out of school making more than $60,000 may not be able to take the student loan interest deduction. But the reason why they kept that is because the national debt is at $26,700 per student on average. So they're not going to eliminate those credits. A big change has to do with your divorce decrees. So in 2019, you're no longer required, based on an agreement after December 31st, 2018, a divorce decree and a legal separation agreement that's recognized in the state. After 2018, alimony does not need to be reported, and alimony therefore doesn't get deducted. And that was based on a study by the Treasury Inspector General in 2014, looking at 2010 tax returns, where they found a mismatch, obviously, between reporting alimony and the deduction of alimony. So I have a planning tip. If any practitioner has a client or a taxpayer themselves who is in the middle of a divorce, of course, you want to finish those before December 31st, right, to get under the old reg if you're looking to get the deduction. But if you're already in an agreement and you're receiving alimony, you're a recipient, you can actually request a revisitation of your alimony in court, and then if it does get changed after December 31st, 2018, and it's a new agreement in 2019, you don't have to report your alimony. Of course, the reverse is the alimony doesn't get deducted, but that's just something to think about with this new provision. We're going to go through the Schedule A, so we'll talk more about medical expenses. As you probably know, your moving deduction has been removed, except for the armed forces, and now employers are required to include reimbursements of those in income. Big hit to the Schedule A, job-related expenses. So a lot of us have clients who maybe are salespersons, work for a company, use their vehicle, computers. Obviously, we file a 2106, which captures all that, has a home office deduction. That has been repealed. However, I was having discussions with the IRS stakeholder liaison last month, and we both determined that you have to actually keep up your 2106 schedules and your depreciation schedules for your equipment that have to do with your Schedule A, miscellaneous expenses, because when the law sunsets in 2025, you will be required to start from the point where your depreciation ends, okay, in 2025. So you'll need to keep tracking that. Also, New York State has decoupled, and we're going to just talk about some of the state impacts. New York State has decoupled from the federal Tax Cuts and Jobs Act. So you are allowed to itemize on your state return as long as you go over the standard, even if you're not doing a miscellaneous expenses, that could be added to your state write-offs. They're going to follow pre-2018 rules, tax rules. So, and I'll mention it as we go along, but that you can use that concept. The only thing that New York hasn't decoupled from is the opportunity zones, qualified opportunity zones, which I have towards the end of the presentation. What does stay on your miscellaneous expenses? Gambling losses, that's still allowed up to gambling income. Tax with respect to state tax with respect to income from a decedent, that stays on there. Social Security adjustments stay on the miscellaneous expenses. So those are not subject to 2%. Okay, so those stay, and again, I'll show you the mocked up version. Originally, the House wanted to repeal the alternative minimum tax. It didn't get repealed, it got limited. Reason being, it was a trade-off for the $1.5 trillion revenue loss that is occurring from the implementation of this tax law. We'll go over that in a detailed slide. And then, of course, net operating losses for your businesses have been reduced in 2018, and I have a separate slide on that, to 80% of your taxable income. And also, there are no carrybacks from 2018 net operating loss. It is infinitely carried forward, and we'll talk about the impact of prior NOL. And for those clients that you have as casual and professional gamblers, they actually leveled the playing field between the casual gambler and the professional gambler. What does that mean? In 2017, the casual gambler was able to write off their gambling or wagering expenses against wagering income, breaking even. So right up to the amount as long as you itemize. And you still could do that as long as you're above the standard in 2018. But the difference between a professional gambler who reports it on a business schedule, they were allowed to add non-wagering and wagering expenses. So what are non-wagering? Your transportation, your meals, entertainment, and so on. Ordinary and necessary expenses related to the professional gambling. But guess what? In 2018 now, you can only break even. You cannot take a net operating loss as a professional gambler. So you're pretty much in the same playing field as your casual gambler. And I thought that was important to note, and also this was from the Journal of Accountancy in April 2018, and they thought that was important to let you know about that. What about our primary exclusions on our homes? That has not been changed in conference committee. That stays the same. So from the point of sale, looking back 5 years, any 2 years that you own and live in the property, each of us gets a $250,000 exclusion, and then we could recapture it every 2 years. That stays the same. Married couple, only one of the spouses has to own the property, the primary. Both need to live in it. And also, if one of the spouses dies, the surviving spouse is permitted to use the $500,000 exclusion within 2 years of the date of death. So that all stays the same with regards to your primary homes. Like-kind exchanges, however, now in 2018 are real property to real property. No longer can we use various types of capital assets like business assets, virtual currency, and the like to do a like-kind exchange. In addition, when you're doing the like-kind exchange in 2018, when we do cost segregation, where we segregate out some of the lower life assets instead of the residential or commercial asset, we bifurcate out the equipment, etc. Those are no longer eligible for like-kind exchange. So you will actually pay income tax, you will pay the capital gains tax rather, on those when you do those transactions. If you're in agreement in at the end of 2017, which is already passed because we're in December, you would and that like-kind went into the next year, then you would have probably went on extension, waited for the transaction to finish at the beginning of 2018, because you have 180 days to do your exchange. That like-kind is based under the old regulations. So you don't have to do like real property to real property in that case. And of course, in a like-kind exchange, what's great about that, and it still exists, is that you actually get the step up on the date of death of the owner of that property. We're going to talk about a great new tax law that came into effect with the Tax Cuts and Jobs Act, which is your qualified opportunity zones and qualified opportunity funds. There is no step up with that. So I just wanted to bring that up. When we get to it, I'll remind you. Personal casualty losses on your Schedule A are completely eliminated except for your hurricane-related areas. So Florence, Michael, in these areas, federally declared disaster zone, you can write off casualty losses. It hasn't changed for your businesses. Now, most of these regs sunset in 2025, unless Congress decides to make them permanent later on, which may not happen, but we should be prepared for that. Involuntary conversions, if anyone has dealt with that, that's a condemnation of a building, part of a building, or the city or the state takes over a piece of property that you own. That's considered an involuntary conversion. And you can have a gain on that. That's still in place where you could defer the gain under Section 10.3.3. That has not changed on the like-kind exchange area. Okay, so remember I said December 15th of 2017 being a very important date in the Tax Cuts and Jobs Act? That has to do with your mortgage balances. So any mortgage that you went into or your client went into prior to December 15th of 2017 is subject to the old limitations, which is $1 million for your joint, $500,000 for the singles and others, and then for married filing separately. So we have to look at the date of when the mortgage was put in place, so it could be a grandfathered-in mortgage, which means that you're allowed to write up to 2 qualified residences interest on your Schedule A if it's pre-December 15, 2017. If it's December 15, 2017 after, then you're subject to limitations. $750,000 from $1 million and $375,000 on the $500,000. Okay? So I'm going to give you some examples of what you need to be aware of. And they're also relooking at the mortgage insurance premium deduction. That has expired. That is not in place right now. and it may end up coming in place with the extenders in January. So, and what about our HELOCs, our home equity lines, or home equity loans, however you want to call it? Any of those loans that are used for personal expenses, credit cards, student loan interest, big ticket items, the interest is no longer deductible on your Schedule A. Okay, so let's go through some examples because that might help you understand. In these three examples, we have the taxpayer in January of 2018, the current law, purchasing a main home and taking out a $500,000 mortgage. In the next month, on the first example, the taxpayer takes out a $250,000 home equity loan to put an addition on the main home. Both loans are secured by the main home, and the total does not exceed the cost of the home because that's an additional provision in the Tax Cuts and Jobs Act. So the question is, are these loans deductible as far as the interest is concerned? And in example one, yes, these loans are deductible because we stayed within the $750,000 limitation, and also the loans are secured by the home. Of course, as I said earlier, if the home equity loan was used for personal purposes, then it would not be deductible. And what does that mean? We're going to have to be doing tracing as taxpayers, tracing as tax preparers to determine where these funds are being used, whether these funds are encumbered by the property. So again, speaking with the IRS stakeholder liaison, they're saying that IRS is going to be starting a campaign. They're already working with the mortgage companies to make these statements more detailed for 2019. We already know that we have the acquired date on the statement. We have the balance on the statement. We know what property we're talking about that's encumbered on the statement and who the debtors are. They're trying to make them more detailed, and they're going to actually do a campaign to look at 3 years in a row, from 16, 17, 18, or 17, 18, 19, depending on when they get the program up, to determine if the mortgage balances are going up. Because if the mortgage balances are going up, then you're going above the cost of the home, the original cost, and that interest is not deductible. So that's something that's out there that might be coming in 2019 that I wanted you to be aware of. In example 2, in January, the taxpayer takes out a $500,000 loan to purchase the main home. The loan is secured by the main home. The taxpayer takes out a $250,000 loan to purchase a vacation home. The loan is secured by the vacation home, and because they're being secured by both homes, you're allowed to have up to 2 qualified residences. You can take the interest deduction for these loans. Okay, and we didn't go above the $750,000. However, of course, in example 3, I had to give you a scenario that goes over the $750,000. And because it goes over, we have a purchase of the main home for $500,000 secured by the main home. Then the loan, in February of 2018, the taxpayer takes out a $500,000 to purchase a vacation home, and the loan is secured by the vacation home. So you would say, oh, I get the interest deduction. But because both your loans exceed the $750,000, then you have to go to the publication 936 to determine the formula of the amount of interest that is deductible. So we've spent a lot of time on Section A, mortgage interest, and that's a lot of preparation time for a practitioner and for a client. I don't see the penalties increasing in this area, but we'll talk about later with the qualified business income deduction where it does. There are favorable changes in the Tax Cuts and Jobs Act. I gave you some on this slide. Income resulting from the discharge of student debt due to death or disability in 2018, that is no longer included in income. No changes to the existing laws, as I said, to the Earned Income Credit, the American Opportunity Credit, the Lifetime Credit. There's an additional child tax credit. So those are all available. Okay, and we also have what is called a saver's credit if you stay within certain income ranges for your 529 plans, okay, which have been expanded, where you can take up to $10,000 in you can make up to $10,000 in a distribution from your plan, right? In the year of distribution, you can make distributions, elementary and high school expenses, and that are qualified under the 529. Also, registered apprenticeship programs are included in there. There's also the 529 ABLE account that is for the disabled beneficiary. They must be an owner of the account. They could have up to $100,000 in the account without violating Medicaid and SSI benefits, and they're actually allowed to contribute more based on their earned income and a comparison of the poverty level in the previous year, federal poverty level guidelines, which is in the area of about an additional $12,140. Now, what I want you to understand in New York is that New York State decoupled from that expanded elementary school K through 12, which means if you take distributions from a 529 plan, the benefits must be recaptured on the New York State return. So they are not in sync with the Tax Cuts and Jobs Act on that. And about 13 states allow contributions, and New York is one of them. New York allows up to a $10,000 contribution on a joint return and $5,000 on others. So that's why they want the recapture. New Jersey and California do not have a deduction, and there are other states which you could check their sites as well. The charitable contribution, cash and non-cash, the amount that you're allowed to contribute, the adjusted gross income level has gone up, so you could do it subject to 60% of your adjusted gross income as opposed to 50% in the previous year. What is not included now in the Tax Cuts and Jobs Act, and you'll see later, is entertainment. So if you're an alumni of a college or a university and you were buying the season tickets, you were able to get an 80% deduction, charitable deduction. That is abolished. That's no longer allowed in 2018 to 25. And we're going to talk about entertainment expenses also being repealed. The bottom of the slide talks about 100% expensing, but we're going to talk about that later, so I'm not going to go into details. Now, the 1040 postcard has 6 schedules, and it also has adjusted gross income adjustments. So I wanted to just point out that these still remain in the Tax Cuts and Jobs Act. You have performing artists that are allowed to write off expenses above the line, and government officials who are paid fees except for lobbyists. So the performing artist definition, as it says here, is with an AGI of $16,000 or less that get paid $200 or more from 2 or more employers. They're allowed to do up to 10% of their expenses that exceed their AGI by 10%. Government officials and also National Guard and reservists are also able to do above-the-line deductions. And believe it or not, that's where you use your 2106 and your 2106EZ. Okay? That still stays for these expenses. What also stays in the Tax Cuts and Jobs Act, if you're an investor, is specific identification method. And what that means, and we told you here at SCORE, the Pension Protection Act came of 2006. We talked about in 2007 here, and we told you that IRS is going to track cost basis. After 1111 for your equities, they're tracking your basis using the FIFO method. After 1112, mutual funds, they're tracking your basis. They wanted to get rid of specific identification, but this is a strategy, and this is what you could also use before December 31st. You can make a letter of instruction to your broker, or have your client do so, to select a particular set of shares or positions that they're holding, instruct them to sell those positions, act on it, provide you a trade confirmation, and you now have controlled your gain or loss. The Senate wanted to get rid of that. They wanted to do the FIFO method, but that has stayed. And you still have time before the end of the year. Another favorable clause, as we know, is the estate tax doubled. So here we say on the slide, it's kind of rounded. The actual number is it's at 11.18 million federal threshold, meaning we don't have estate tax returns federally required under that threshold. Of course, New York State is decoupled from that. They're in the $5 million area. We still have portability, which means you can actually file an estate tax return and request the unused portion of the deceased spouse threshold, bring it over to the surviving spouse. If you do that, then you're subject to basis reporting, which can be a 6-year look back. So I'm thinking less and less people are going to be filing estate tax returns, because I think it's in the area of something like 400,000 estate tax returns that they get anyway. But what I am noticing is bypass agreements, those credit shelter trusts that were in place like 20 years ago. I just worked on one where they did a distribution from it because the estate threshold now is so high. They don't need to pay the fees any longer on these trusts. So I wanted to let you know that there's many concerns that if we have such high thresholds and we can gift up to $11.2 million, is there going to be a clawback by the IRS when the threshold decreases? And the IRS says no. And they did that on November 20th, 2018. The IRS announced under IR 2018-229 that they are not going to do that. So you can take advantage of the gifting up to the $11.18 million per taxpayer. Okay, so on average, how do we think this Tax Cuts and Jobs Act affects us? There's many studies done, and many based on the House and the Senate version. Since this is mostly the Senate version of the bill, I used some analysis from those particular companies, those organizations that did the analysis. And it shows if you stay under the area of $70,000, you will see a tax cut. Okay, and I'm going to go through a chart of various families, but first let me go through the tax rate schedule. If you look at my booklet on page 4, there's your tax brackets. And you'll notice that the bracket, the 10% bracket on the single taxpayer stays the same. But I don't think about the tax brackets. I think about how do I pay 0% capital gains tax, because that's what everyone's really concerned with. So if you go to page 10, you'll notice that has changed with regards to the brackets. The brackets, as you see on the right side of this PowerPoint, go down by a few percentage points. So our 15% bracket goes down to 12%, and we still have 7 brackets. So the 12% bracket for a single taxpayer, if you stay below that $38,700, I believe it says $38,600, with the capital gain, you will have 0% capital gains tax. That has not changed. As you move down the brackets, you'll stay at 15%. And then when you hit 35% at about $429,000 of taxable income, you're going to hit the 20% bracket, or your client's going to hit the 20% bracket. And then, of course, 37%. You'll know, and you probably know, that the 39.6 bracket reduced to 37%, and less people are in that bracket. Why? The taxable income went up, if you notice. Look to the left, single, $426,700 under the old law, taxable income to get in the 37% bracket, $500,000. So that's why many argue that this is helping the higher earners, right? Because we're reducing AMT, and now we've expanded the brackets. Married couples, if you go to that same page on page 4, and then look at page 10, you will notice, again, the 10% bracket stays the same, and we work our way down to the 12% bracket. That reduces the 15% bracket from the year before by 3 percentage points, and the 0% bracket stays within below $77,400, and that's how you pay 0% capital gains, including your capital gains in that bracket. As you move up again, 15%, and then when you hit the 35% bracket at $479,000 taxable income, that's when you hit the 20% brackets, 35% and 37%. And again, the 39.6% bracket went down and increased the threshold from $480,050 to $600,000. So obviously less people are getting into that top bracket. So I don't know if you can see the chart, but again, this PowerPoint is going to be provided. If you provide your email, we'll send it out to you. There's a lot of proposed regs, so we wanted to wait till January. In fact, IRS isn't doing some presentations on certain portions because they're waiting. But what this chart shows you, if you notice, let's see if I can do this pointer, 2.3% change in after-tax earnings. This particular filing status, which is a single one earner making $52,000, that's your biggest impact from this Tax Cuts and Jobs Act. They're going to estimated get an $1,192 additional refund. $1,192. But guess what? I think you've heard a lot, do your payroll checkup, do your payroll checkup, right? Why? Because Congress changed the tables when the Tax Cuts and Jobs Act passed to give you more money in your pocket. So that means, on average, they could have been giving you $700 to $900 per earner. So if I'm saying this filing status is getting an additional $1,192, subtract $900 from it, let's say, or $700. So your refund is really only an additional $400. And as practitioners, that's something we had to be aware of, as we were doing the planning. When you get over to the right side, which is your higher earners, you'll notice here the $325,000 couple, 2 earners, they maximize their retirement plan. Their after-tax earnings is going to go up by 1.3%. Why? And $800,000. Because the alternative tax has gone down. Okay? The alternative tax has gone down. And so this particular couple for $325,000, I did an analysis, they save about $3,000 just on their alternative tax. So there's a big impact with that. It's still in place, and you still have to do planning for it. But, you just want to be aware. I'm going to go quickly through these slides. This is just showing you New York's reaction to the Tax Cuts and Jobs Act. The New York State Society of CPAs wrote a letter to the New York delegation of the U.S. House of Representatives, and they say it's a fiscally irresponsible and disastrous to the economy of New York. So, that's why they're decoupling. And of course, December 2nd, the Senate passed it anyway, and it went from conference committee on December 15th, and then, as I said, it was passed. So you have analysis by various bipartisan groups, such as the Tax Foundation. The Tax Foundation found that this Tax Cuts and Jobs Act would actually increase GDP by 1.7% and create 339,000 full-time equivalent jobs. I'm going to talk about some of the perks to the businesses. Going to the alternative tax, what you need to know, if you go into the booklet, there's a section on AMT, and it actually shows you the married and the single. Thresholds and exemptions go up. So they increase from the 2017 level of $84,500 for your joint filers and $54,300 for your other filers, and they went up to $109,400 for joint and $70,300 for single. So there's an increase, right, in your exemption right here. So that means less alternative taxable income. And then the phase out, you see the phase outs from the 2017? They went down from $1 million, from 160,900 to $1 million. It went up rather, and then $500,000. So your phase outs went up, which means less people being caught into the alternative tax. But they couldn't get it abolished. And, however, corporate alternative tax has been abolished. So that's why they feel a lot of the corporations are benefiting more from this Tax Cuts and Jobs Act. But, as we know, there's a 20% qualified business income deduction, and you can use that against alternative tax. So that's a good thing. All right, so let's talk about what changes there have been for the businesses. We know there's a flat 21% federal corporate tax rate with anti-abuse rules in place. We know we have a 20% deduction of qualified business income for certain pass-through businesses, as we talked about, sole proprietorships, partnerships, S-corps that could benefit from this. I'm going to tell you that you don't need more than likely, in many instances, to change the entity. Because when the Tax Cuts and Jobs Act came out, that was a worry. We might have to change our clients, the setup of our companies, the setup of the businesses, our own businesses, or the taxpayers themselves. But because of the introduction of the 20% QBI and some of the proposals that have been passed, we don't have to do that. Also, we have 100% expensing on our lower lived assets, less than 20 years. 100%, write it off in that year. So a lot of capital investment going on in businesses. Section 179, first year expensing, has gone up from $500,000 to $1 million with a phase out to 2.5. So if you have a lot of investing that you can do in your businesses and still take advantage of before the end of this year. Cash basis. We can now use the cash basis of accounting in more instances than before. Any companies under $25 million can now use the cash basis of accounting, even if you have inventories. There's an exception. If you have an applicable financial statement already, then you must use the method that's in the applicable financial statement. And you'll find that the Tax Cuts and Jobs Act and the accounting rules and regulations are now coinciding together. And also what's going to happen is your contractors out there are going to be more eligible to do the completed contract method as opposed to have to doing calculations of the percentage of completion. So this is favorable. The only thing is if you decide that it's changing from accrual to cash is what your business or the taxpayer should do, then you need to request permission or report that rather on a Form 3115, which is a change in accounting policy. It must go with a timely filed return. It must be sent separately to the IRS. Now, AICPA is trying to work with the IRS saying, can you make this a little bit less of a hardship for these businesses? Because those forms are lengthy, and that's still in the process. So right now, you'd have to use a 3115 to make the change. What about net operating loss carrybacks? We like that, right? The president liked it. He took 100% off his taxable income. It's not 100% anymore. They now limited it to 80% of your income. In addition, you can't take more than $250,000 as a single person net operating loss in 1 year, and $500,000 for a married couple. So you do your limitation, and then you figure out whether you go over those thresholds. Otherwise, it has to be carried forward. Also, there's no carrybacks. So we don't have to do an election for the carryback. But there's pre-2018. So what you have to watch out for is the Tax Cuts and Jobs Act says you have to add those carrybacks to your current NOL when calculating the limitation. So I'm going to suggest to you, you may want to use those carrybacks and do tentative refunds in the 2 previous years, so you get rid of them. Okay, so that's just something, a little point. But let's just go to an example. This might be helpful just so you understand how the application is of the formula. So if I have taxable income of $100,000 and I have a net operating loss of $200,000, I can use only 80% of the taxable income, which is $80,000. That means I bring my income down to $20,000. And then I have to look at my net operating loss of $200,000. I subtract the $80,000, and I'm left with $120,000 carryover. And then I can carry that over indefinitely. So that's basically how that works. The next slide has to do with interest deduction limitation. Let's face it, most of us are under $25 million, so you're not going to have an interest deduction limitation unless an auditor thinks that interest is not producing income for your business. So you'll be able to take off 100% of your interest. This is for your more than $25 million. That limitation applies to businesses that are more than $25 million in gross receipts, so most of us are exempt from the limitation. But what we're not exempt from is entertainment. We can no longer, as a business, as an employer, deduct entertainment, amusement, and recreational activities, membership dues relating to a business for pleasure, recreation, and other social purposes. And any facilities that might be connected to that, okay? Like I talked about earlier, going to a game. all right? So that is mandated, that's in place, and it affects how you calculate your meals. So I give you some examples in the PowerPoint for meals that do stay at 50%, because we were worried that meals were going to go away also, but meals are still in place. The restaurants are still going to have the businesses coming in, and you're more than likely going to be subject to 50% limitation. But let's talk about a couple of scenarios. If I'm at a ball game with a client, I must make sure the ticket defining the food is separate, right? So I must be charged separately for the food. If I'm in a suite, we cannot take off the food that's in that suite for that particular game or entertainment activity. So it must be bifurcated, it must not be lavish, it must not be extravagant. This is all normal stuff that we always know. And we must talk about business before, during, or after the meal. And of course, with a lot of the accounting programs now, you could document a lot of this stuff, right? And you can even upload the receipts. So that's not really a problem. But this last one I really liked or chuckled at was in your office expenses. You know, if you have coffee, tea, snacks, water in those expenses for your office, you now have to comb through those, take those out, and subject that to 50%. Okay? So that's something that we might, as practitioners now, they want us to do for our clients. So, you know, just keep that in mind. Are there any meals that are 100% deductible? There are holiday meals for employees, holiday parties that are off premises. Now, there was a drafting error in the code, and it said entertainment is also 100% deductible, but they said, no, don't follow that, because that's a drafting error, and we're going to correct it. So there's a couple of drafting errors, and I'm going to tell you about it. Qualified transportation fringe benefits. Basically, what this regulation says is, look, we're not going to allow you to have fringe benefits for commuting anymore, all right? Unless it's for safety reasons. You're not able to deduct those benefits. For example, New York City requires that employers with 20 or more full-time employees provide pre-tax vouchers for parking, for commute, for the highway, and all that, you know, $260 per month. And the federal had that, but the federal decoupled and now said that that is not deductible and must be added to income, okay? And it also affects your tax exempts. All right, which I have 2 slides at the end. Now, with the tax exempt, you either have to choose adding those certain expenses into income or do an unrelated business tax schedule, separate from your other schedules with your tax exempt. They must be separate. But I'll go through that at the end. Temporary 100 expensing for certain business assets. So that's for your lives of 20 years or less. 20 years or less. So your computers, your water, utility property, these are specific ones that they define, film, TV, live, theatrical productions, anything that's in a 20-year or less life, you can do 100% bonus depreciation, okay? And you can do that till 2023, where it's for assets that acquired after September 27, 2017. So you could have done this in your 2017 tax return. You might have noticed that if they asked you a question. But now, of course, it continues till 2025, but the 100% only goes till 2023. And then after that, it reduces 20% per year until after 2027, it's zeroed out. Except if you own an aircraft. If you own an aircraft, it takes a little bit longer, okay? But what is introduced into this bonus depreciation is that you're permitted to use used assets. What's the definition by the IRS of a used asset? I thought this was interesting too. The used asset cannot be used by the predecessor. So I'm saying, how do you buy a used asset from a predecessor if it's not used? If it was, it should have been used, but no, it had to be sitting in their inventory or sitting in their business unused, and you purchased this used asset. So that's the definition. Also, it cannot be acquired from a related party. It cannot be acquired from a controlled group. And it cannot be acquired from a like-kind exchange. The Tax Cuts and Jobs Act, for some reason, is not favorable to the like-kind exchange area. Okay, so that's your provisions with regard to 100% expensing, 20 years life or less. How about luxury automobiles? We all like to purchase those, right? You could do bonus depreciation with those. And by doing that, in the first year, on a regular depreciation, you can write off $10,000. But under bonus, you're allowed to write off up to $18,000 in the first year. Now, of course, that's subject to how much use. Generally, when you do bonus, you have to have at least 55% use or more. So it's based on the percentage of use. But this is the table: $18,000 for the first year, $16,000 for the second, $9,600 for the third, and then $5,760 for each taxable year in the recovery period. Okay, so that's something that's been promoted, and of course they want you to buy cars. All right? But the Act also plays with the depreciation schedule. Like we told you about here, we had the tangible property regulations a couple of years ago, where you make a de minimis election that you should be doing annually, that says my business can purchase and spend up to $2,500 on one item, on one invoice. Well, that's your computers and peripheral equipment. So guess what? Computers and peripheral equipment is no longer on the depreciation schedule. That has been removed. So now you have to scrub your depreciation schedules in 2018. All right? In addition, Section 179 has been expanded, which means that not only do you have bonus, but you have more that you can add to writing off in the first year. So if you're a facility that's like a dormitory or a housing facility or an apartment building that provides living, you're now allowed to Section 179 furniture, refrigerators, ranges, and other equipment. And it also expands Section 179 in the commercial area, in the commercial property area. So now interior items can be 179 deductible, as well as your HVACs, your security systems, your alarm systems, roof, right? That is eligible now for Section 179. And that's very important, right, when we're talking about that. But I'm going to tell you how that impacts the qualified business income deduction later. Now, we all heard of qualified leasehold improvement property, qualified retail property, and qualified restaurant property. These are your tenants that have leases, and those are generally 15-year life, right? So those would be eligible for bonus depreciation starting September 27, 2017, and thereafter. Problem: there was a drafting error. So when they drafted the Tax Cuts and Jobs Act, the category was put all together as a qualified improvement property. That's great, because now you don't have to say every category separately. But when they drafted it, they put it under the 39-year property. So the qualified improvement property, even though it's 15-year, sits in a 39-year property, which means we can't bonus depreciate until they change it. So I don't know if that means we have to go an extension, but that's something you should be aware of, because they may be changing. They're probably going to be changing that category. They just haven't gotten to it yet. Okay, so that brings me to the proposed regulations of our favorite subject that everyone has heard about, is the qualified business income deduction. And that's why I think a lot of us are here today. That's your 20% qualified business income deduction. That pass-throughs. I think it talks about it later on in my booklet, but very general. I gave you a flow chart. I don't know if you have the flow chart there. I'm not going to refer to it yet, but it might help you if you look at the supplemental materials that I provided you, which is the flow chart on trying to understand all the thresholds. So, the qualified business income deduction. First of all, we have to define what a qualified business is in Section 162, which is most of your businesses, but they're flow-through businesses, not C Corps. And then, of course, what's separated out is your specified service, trade, and businesses, and we're going to talk about that. all right? 199A is the section for the 20% qualified business income deduction. That replaced section 199. 199 was the qualified production deduction, income deduction. That was for your fabricators, your manufacturers, your construction companies. I don't know if anyone used this. Your architects and your engineers. It has been in place for years. I used it. It gets reported on your K-1 when you do the businesses, and then it gets deducted on the personal returns. It's the same concept. The IRS auditors have and know how to audit this area. In fact, they increased the penalties in this area. So you have to really understand how to apply the QBR. Okay, so the first step, we determine if it's a flow-through, we determine if it's a specified service, trade, or business, which I'm going to define for you, and then we determine, are we below the threshold? The first threshold, married filing joint, $315,000 of taxable income. So if we're below that, not counting the qualified business income deduction, then most businesses are going to be able to take the 20% deduction. So that's the first step. If we're single and all others, and we're under $157,500, then we're going to be able to take it as well. All right, so what was the IRS thinking about when they passed the 20% qualified business income deduction? They were thinking about abuse. That's what they were thinking about. So all the proposed regs that are out there about how are these taxpayers going to abuse this law? Okay? So what did they do? They automatically carved out specified service trades and businesses. And those are your health area, law, accounting, a lot of accountants here, actuarial science, performing arts, consulting, athletics, financial services, brokerage, investment advisory, and the such. What is the key of all these businesses? It's the reputation and skill of the business owner or their key employee. So that's the key of that carve-out. The only thing that they took out, the only businesses they took out were engineering and architects. That's because they were allowed in the 199, the engineers and architects. So they're not subject to the limitations. And what I'm also going to teach you today is that even in those specified service businesses, there are exclusions in those businesses. So now you have to think heavily about your business descriptions that you're using. Don't call everybody a consultant, right? Look at the NAICS code that you're using. This is going to be used now to determine whether you're over the thresholds. And how do you bring yourself below the thresholds of $315,000 and $157,500? Well, you can contribute to a retirement plan, right? It's before December 31st. You need to look at those clients, you need to look at yourself, and see if there's plans that could still be put in place. Now, you can't do 401ks because we're past the date, but you could do your SEPs, you could do your simples, right? And IRA contributions till April, and we could reduce the taxable income so that they can get the full 20%, or we can get the full 20% deduction. Okay, I think I went backwards here. So, before I start getting in some of the higher levels and how the limitations are applied, what if I have a mixture of a non-SSTB, non-specified service trade or business, right, and a specified service trade or business? What if I have a mixture in that particular business? Let's say, for example, I'm a salesperson or a consultant, but I mostly sell. I mostly do selling. I just provide consulting as an ancillary service to help them install what I'm selling to them. So now IRS has created proposed regulations, which more than likely will be finalized, but haven't yet. They're still proposed. And I give you an example here. So ABC Company has annual revenue of $20 million. $18.5 million of the revenue is attributable to the sale of computers. The remaining 1.5 is attributable to consulting, installation, and training. Because ABC's consulting services are less than 10%, and that's the proposed reg, then they are not considered a specified service trade or business. So they're not subject to being disqualified after the thresholds, which I'll talk about. So that's one proposal. Then there's something called the crack and pack proposal. What is that? Well, when the law came out, automatically people were trying to determine maybe if I separate my specified service trade or business and I start another entity and I flow through there. IRS said, listen, if you're a specified service trade or business, this is how we're going to define whether that other entity is connected to you. First, if you're common owners. So if you're 50% or more common owners, that's step one. Step two, if you have a rental property and you're paying rent to that other entity, and you're paying more than 80% rent from your specified service trade or business, guess what? They're disqualified. And that's the proposed reg. Okay? So, illustrate. Tax and accounting firm, specified service trade or business, not eligible for 199A if over the thresholds I just told you earlier, but there's a phase out. The accounting firm owns a commercial building in New York City. The firm effectively will not be permitted to contribute this real estate to a newly created pass-through. They can do it, but the pass-through will not get the 199A, the LLC, if they're both 50% or more owners and 80% or more of the income is going to the LLC. But then I say, wait a minute, I don't just rent to myself, I rent to others. Well, okay, then if you prove that you rent to others, we'll give you the 1099A, the 199A deduction if you're within the limits with the phase outs in that particular entity. So they actually have proposed regs that cover this area. What about if I have a business, and I'm going to give you an example, a restaurant and a caterer, and they're separate entities. One of my businesses doesn't have employees. They have independent contractors. And I'm going to say in this scenario, that's the caterer. The restaurant has employees. But when I go over the thresholds, which I'm going to tell you in a bit, I have to apply a limitation based on my payroll, on my W-2s. How do I get the 199A deduction for the business that doesn't have employees? Well, now there's proposed regulations that says I can aggregate those businesses as long as those businesses are not specified service trades or business, right? Services that I told you about. They have to be non-SSTB. I can aggregate. And once you aggregate on a timely filed return, it cannot be revoked, okay? So let's move forward. Here's an example. John is an unmarried calendar year taxpayer and a small business owner. He has taxable income of $300,000, and so he's over the maximum threshold, not as an SSTB, you'll notice $207,500, but a threshold where he has to apply a limitation on his 20% deduction, and that's based on wages. So we move forward. John operates and owns a catering family business and a restaurant business through separate single-member LLCs, separate LLCs, okay? The catering business has qualified business income of $300,000 and the restaurant $50,000 after W-2s. So the catering business couldn't get the qualified business income deduction. They have no wages, so it's zero. But if he elects aggregation, then he could join the two businesses' gross revenues, the $350,000, apply the 20%, and have a tentative qualified business income deduction of $70,000. But it has to be below my wages limit, which I then will use the restaurant's wages of $200,000 to apply the limit. In this case, would be 50% of $200,000. $100,000 is the QBI limit. That means I would take the lower of the two, but there's a third step. It's the lower of the two, then the lower of 20% of taxable income, which if you recall on top is $300,000. So the lowest tentative qualified business income deduction I could get in this case is $60,000. That's because I'm aggregating. Otherwise, if I did not elect aggregation, the catering business would not be able to get it, the restaurant business would. Okay? And then the bottom of the slide just says, listen, if you're below the threshold, you don't have to worry about aggregation. What else do we need to know about aggregation? They can't be specified service trades or businesses. They must complement each other. They must have centralized activities like an accounting activity, payroll activity, websites, these centralized activities between the two of them, they can aggregate. And guess what? You can aggregate with family attributes. You can use your spouses, your children, your grandchildren, and your parents' businesses to do aggregation, to elect aggregation under this rule. They're trying to make it flexible so that you don't have to change entities. Okay? So they will no longer have to worry about changing entities. So how do we apply the limitation? When do we apply the limitation? Well, I said you have to be below taxable income of $315,000 for the married couple, without counting the qualified business income deduction, and $157,500, right, to get the full deduction. If you're a specified service, trade, or business, and again, if you don't have the flow chart, I'll get it for you, because that's very helpful. If you go from $315,000 to $415,000 as a married couple, and you're an accountant, you're going to have a phase out of the deduction. And the phase out is based on how much of a difference between that $100,000 you are over the full $100,000 minus 1, because you have to do the reverse. And you apply it to the qualified business income deduction. And then you obviously are lowering your deduction as you're phasing closer to the $100,000. So once you get over $415,000 for a married couple as an accountant, because I'm saying accounting because a lot of accountants here, then you don't get the qualified business income deduction. Okay, so you have to stay, if you're over $415,000, specified service, trade, or business does not get it. Over $207,500 is for singles and others. Same scenario. That's why we want to strategize. Use retirement plans. Maybe we could get ourselves down. Because after those numbers, we cannot get the deduction. Now, for the other businesses, as you go over the thresholds, they have to apply the limitation. They don't ever get stopped, okay? Unless they don't have wages to apply the limitation. Then they get 0. Okay, so it's called the Tax Cuts and Jobs Act, because they want to create jobs. That's why they're requiring a wage limitation. Now, when you apply the wage limitation, it must be based on timely filed W-2s within 60 days of the deadline. And you can also use a common paymaster. So let's say you have a lot of businesses and you're aggregating, and there's a common paymaster company that pays all the wages of all these businesses. You can aggregate all those companies together. So, and that's an exception. So, within the specified service, trade, or business, it just reminded me, I didn't tell you. For example, in the healthcare area, if you sell pharmaceuticals and equipment, if you're doing research and analysis, or if you're a spa, you're not a specified service, trade, or business. So don't think because it's in a health field that you're automatically, exempt. You can consider it an SSTB. If you are a lawyer in the legal field, in the law field, well, printers, deliverers, process servers, stenographers are not based on legal licensing. They're not in the specified service, trade, or business area. For the accounting area, your payroll processing companies, your analysis companies, and billing companies are not a specified service, trade, or business. So they are exempted out. So what I'm going to tell you, in each of these areas, there's an exception. In the consulting field, if I sell, and I just happen to be consulting like I told you earlier, not a specified service, trade, or business, so you shouldn't worry after the taxable limitation. What if I have businesses that have a loss in that year? So for an example, in this scenario, I have A, which is allocated a qualified business income in business one of $20,000, but the second business has a $50,000 loss. And so guess I have a $30,000 net operating loss between the two. You can't take the qualified business income deduction in that year because you have net losses. So you're going to carry over the loss into year two, which would be 2019. And then you're going to compare what happens to the two businesses in the next year. The two businesses make income in this scenario, obviously, because we want to show you what to do. And so the two businesses make $50,000 and $20,000, which is $70,000 of income between the two in 2019. You times the two businesses by 20%. You have a $14,000 tentative qualified business income deduction. But remember, we had a loss, so we have to take the $30,000 loss, times it by 20%, and we reduce our qualified business income deduction by $6,000, and we're left with an $8,000 deduction. One more step. What if I'm in a year where I have two profitable businesses and a third one with a qualified business loss, but it doesn't offset all the income? I then have to take an allocation of the loss based on the two businesses' income. So if I have two businesses that are making $1 million each, they share 50% each in the offset of the loss allocation to reduce their qualified business income deduction. Now these are in the proposed regs, so you can actually go to irs.gov/tax reform and go to that area to get more on it. But I wanted to show you there's various scenarios that affect this, and also there's various sections of the code. For example, depreciable property. That has a negative effect on qualified business income because when you sell it in the business, capital gains get excluded from QBI, and then depreciation recapture ordinary income does not get included in QBI. So that's out. That's section 1231 for the accountants in the room. For section 751, which is your partnership assets, how do we get a long-term gain in a partnership? We have to hold it now for 3 years, that interest. If we have it held more than 3 years and we sell it, that's excluded from qualified business income if it happens in the year. If we have a hot asset, which is less than 3 years, guess what? That's a good thing. Usually we don't like hot assets because that's a high tax rate, but that helps the QBI. That's calculated in the QBI for this provision. Okay, so the whole provision really was to help bring the tax rate down for the flow-throughs. It was about at 40% at 2017 max. Now, with the maximization of this qualified business income deduction, it brings us down to 29.6%. So how do I figure my QBI deduction if I have capital gains? I'll give you an example here. I'm a married taxpayer. I have $100,000 of qualified business income from my business, right? $100,000 of long-term capital gains, which is adjusted gross income of $200,000. I have $30,000 in deductions, believe it or not, more than the $24,000 standard. So I'm able to itemize. I take the $200,000 AGI, I subtract the $30,000, I'm left with $170,000 of taxable income. How do I figure my 199A qualified business income deduction? Well, it's the lesser of 20% of taxable income. 20% of qualified business income, in this case $100,000, so tentative, $20,000, or 20% of the taxable income minus capital gains. Because when we figure the qualified business income deduction on taxable income, we never include capital gains. It's always minus net capital gains. So there's a new definition out there. It's called modified taxable income. And that's what you compare it to. Modified taxable income. Taxable income minus net capital gains gives me the $70,000, and I times it by 20%. So the lower tentative QBI is $14,000 in this scenario. Okay? Okay. This one I'm not going to go through because it just tells you that if you stay under 157.5 as a lawyer, you'll be able to take the deduction. That I told you also, IRS also released a very lengthy regulation that talks about how you apply the W-2s. I'm going to give you a shortcut. Use box 5. Box 5, on your W-3, timely filed within 60 days. That includes all your gross wages, right? We don't deduct retirement plans when we're using the limitation. What do we think the audit areas will be? Well, we think they're going to look at qualified business income deduction and how you are doing reasonable compensation. Are you deducting wages for the shareholder? Or are you just allowing all distributions, which would increase your QBI, right? Similarly, partnerships use guaranteed payments. So guaranteed payments are not part of qualified business income. You don't get 20% on guaranteed payments. So of course they want the partners to be taking guaranteed payments because that lowers the QBI. And then the partners will be able to get the flow through of the wage for the limitation purposes. Also, many ask, how is this going to be shown on the K-1? Well, similar to the 199A, domestic production deduction, you're going to see on your K-1 under letter P, other information, gross income domestic, gross expenses, gross wages. And that's what's going to be shown on the K-1 to use the information to calculate on the personal tax return. Now, if you look at the bottom of this slide, this increases the penalties right here. This is a special provision that increased the penalties for the application of the qualified business income deduction. You could go to the tax advisor in April where they report this. That's under section 6662. So when some people ask, well, what if I just don't do the QBI deduction? Okay, you won't get a penalty, but you're not going to get your deduction, so, you know. What about rental activities? Most rental activities right now, Schedule E and your estates and trusts, allow for the QBI deduction. The problem area might be your triple net leases. Why? Because the property owner, by the definition of the triple net lease, really doesn't do much for the property. The tenant is responsible. And so you could get disallowed the qualified business income deduction on a triple net lease. So the suggestion is revisiting your triple net lease and creating modified leases, okay, that modify some of those provisions. So because of rental activities, when this law was in conference committee, originally the rental properties were not going to be able to get the qualified business income deduction because there were no wages. Do we generally pay wages in rental properties? No. So then with the limit, we wouldn't be able to get the deduction. So what they did for us is we can get the deduction as long as we use the greater of 50% of the wages or 25% of the wages plus 2.5% of unadjusted basis. And that's how a rental property business gets, or a rental holding company, by basis. Now, you might say, what if my basis is depreciated out already? Some of these properties we have for a long time. Well, there is a provision that says, listen, if your property is depreciated out by the time you're going to apply this, you can't use your basis. However, if you section 179 or use 50% depreciation method, you can ignore those. And you can use the unadjusted basis to calculate it. So the key is you have to make sure your property is not depreciated out, regular depreciation, not bonus, not section 179, before you apply the 20% limitation. Okay? So that's just, without getting into real details. I'm not going to go through these slides because basically what it says is, what if I'm a specified service trade or business and I'm over the 2075, single, you don't get it. If you're over 415,000 taxable income or 207,500 and you're a specified service trade or business, you don't get the qualified business income deduction. So when you get this presentation, PowerPoint, this is the slide you should focus on. That's your formula, right there. Now, probably the tax software is going to take care of a lot of this, but you really should be aware of how it's calculating because it might be calculating it wrong. I know when I did the domestic production deduction, I always had to, revisit it because it wasn't calculating it right. So of course this says qualified business income does not include wages or guaranteed payments, capital gains or losses, and your investment income, interest, dividends, etc. Not qualified business income. But what is qualified business income is what we just talked about, all the businesses we just talked about, and REIT dividends. So if we have investments that invest in REITs and publicly traded partnerships, and let's say you're a specified service trade or business that's over that taxable $415,000, but you have REIT dividends and publicly traded partnership, you still get the 20% deduction on those items. You're not, excluded just because you're over the threshold. So that's what this is saying right here. And then here's your limitations, okay? When you go over 207,500 single person taxable income, not counting the qualified business income deduction, and 315,000, you're going to be subject to the combined limits, which is the greater of 50% of wages timely filed, box 5, right? Or 25% of wages plus 2.5% of basis, unadjusted. And that's the formula. That's the formula. So just understand, from where you leave that 315,000 or 207,500, that's when you have to start applying the limitations. There's just this little tricky part where the specified trades or businesses have a phase out. And that's what you have to be aware of. If I'm a specified service trade or business, over 415 taxable income, over 207,500 without my QBI, I'm out. So I give you a tax court case, right? Because we learn from tax court cases. And I think there's going to be a lot of tax court cases coming up. So we have Slalomir and Alicia. And Slalomir was a statutory employee in 2011, but the box was checked. And what does that mean when you're a statutory employee? You're able to do a Schedule C, a business schedule. You could write off your ordinary and necessary expenses. So he did that, and everything was fine. Then in 2012, the employer gave him a W-2, but box statutory employee was not checked. What does Slalomir do? I'm a statutory employee, so I go to my Schedule C and I write it off. Expenses. IRS says, nope, disallowed, the box isn't checked. Well, Mr. and Mrs. F says, no, we're going to tax court. Guess what? I am a statutory employee. I don't care if a box is checked. That's a mistake. The judge ruled for the taxpayer. And the judge went all the way back to the garment worker rules in 1954. Where you see the tenement museum in the city? They did their sewing and so on. That law says if you're working primarily in your home, using the specifications of the employers and having an output that you are fulfilling, then you are defined narrowly as a statutory employee. So the judge awarded the taxpayer. So now there's entities looking at telecommuters, because a lot of the employees today are telecommuting from home. So they're saying, and there's about 4 million that are doing it at least half the time, and they're saying, you know what? I think this law applies to telecommuters. We may have to argue that they are statutory employees. So this is on the horizon. And then if you're a statutory employee and you have ordinary necessary business expenses, that means you get the qualified business income deduction, right? Because guess what? You're not considered an employee-employer relationship as a statutory employee. So that's something that's brewing. And we'll see what happens with that. But I figured you want to be aware of it if you want to start strategizing. This is where the qualified business income deduction goes. Line 9. But there's a backup schedule, of course. And, of course, you have to use your K-1s. And that's what the code section of the law is based on, so we don't need to go through that in detail. We talked about the partnerships. So will New York be impacted by federal tax reform? You know, we have to always talk about New York because we're here. We told you they decoupled, okay? The hot blue or dark states there, they're fighting with the federal government on the Fed Tax Cuts and Jobs Act, okay? Why? Because of the SALT limitation, going back to the personal expenses. What's SALT? State and local taxes, real property taxes. We're all limited to $10,000 of a deduction on the federal return. 5,000 married filing separately. So this is the big argument of the Tax Cuts and Jobs Act, and this is why the states are decoupling. Just to give you an example, I don't know if I have it here yet. You can't, it's a little bit small, but the red states, they have their own state tax laws. The blue actually are rolling conformity, which means they will adopt as of a certain period. So New York is the blue. They're not adopting, okay? So you're going to have to apply all the old provisions on the state return and then apply the new provisions on the federal return, okay? The green states automatically adopt. And then, of course, these whiteout states, which is really gray, that's your non-taxable, no tax states, such as Florida. Okay, these next two slides just go into the fact, and I just want you to be aware, because I'm not going to go into details, because I'm sure we're limiting on time, but what these states are trying to do is create charitable trusts within the states. So that means that the employer could adopt the plan, make contributions to charitable trusts in the states, pass it down to the employee so they could get a deduction. Basically, IRS said, look, we're looking at this hot and heavy, okay? So if you do this, you're probably going to have to put in a form with your return that describes how you did it. And you better make sure that you didn't double dip. In other words, get a credit from the state for the charitable deduction, and then take the deduction again on the personal return, because we're going to be looking at that. So Connecticut, New Jersey, New York, all these states are doing these charitable trusts. I don't know, I don't think I would be comfortable with electing, but you have to take a look at it. It was proposed August 27th of 2018, so IRS said anything prior to that is okay, but anything after that date, we're going to look at hot and heavy. So just want you to be aware of that if someone comes to you with that, because there are some employers that are electing that. And of course, because of the limitation, many of us prepaid the state and local, right, our real estate taxes. We prepaid them in 17, which means we're probably going to be, a lot of us are going to be taking the standard deduction. So this is what the Schedule A looks like. You have your medical expenses on top. 2017, you're subject to 7.5% of adjusted gross income. The Tax Cuts and Jobs Act confirmed that. And then in 2018, you're subject to 7.5%. 2019, 10% threshold, and going forward. The next line is your SALT, as we said. State, local, real estate taxes, property taxes, all those lines together, you cannot go over $10,000 for a joint return, and for others rather, for single as well, married filing separately, $5,000. Now the states, as I said, New York says, well, we don't care, we're going pre-2018, so you can write off you can itemize. New Jersey says, we're going to take our deduction, our $10,000 max, and we're going to increase it to $15,000. So they actually try to help the taxpayer with regards to this. The mortgage interest, as we said, you have limitations on the balances. The magic date, December 15, 2017, is your grandfathered mortgages. Anything after, let's say you refinance and you increase the mortgage. Guess what? You're under the new rules. Okay? So watch out for that. Gifts to charity. There was a drafting error in the code, and they didn't include non-cash in it. So now AICPA is begging IRS to please put in the cash, non-cash. So I think we are going to apply that, but the limitation is subject to 60% of your adjusted gross income. So you're allowed to contribute more, and then you can carry over. Casualty and thefts, I told you, only for federal disaster areas, and all your job-related expenses are out. right? Certain attorney and accountant fees and all that, financial advisory fees, that's all out. And, of course, at the bottom, we don't have any limitations anymore on our Schedule A. So what's expected going forward? Well, I went to the tax forum in the summer. I don't know if anybody went. And I just decided to take this one presentation because I thought it was going to be nice and simple. Well, guess what? I learned that the IRS is doing S-Corp basis audits. And they're starting that campaign as we speak. And they're going back to the beginning of time. There's no statute. So they want to, limitation, they want to know how you came up with your business S-Corp basis versus your losses. And you better have a schedule that shows that from the beginning of time. And if you inherited an asset, then you have to use your due diligence to have accepted the prior basis. So I was like, whoa, I better tell everybody at the tax update about this. It's coming down the pike. Okay, QBI distributions versus compensation. Home office deductions is on the audit agenda. Safeguarding taxpayer data, that's a little pet peeve of mine. I actually do a presentation for practitioners, and the IAA was great enough to have that presentation for their practitioners. If SCORE wants to do it, I'll gladly do it for the practitioners. These are regs that are in place for New York State licensed agents as of September 1st. You need to have cybersecurity in place, security plans, and also tax practitioners need to have cybersecurity plans in place. Have a whole presentation on that. I told you about prepare a due diligence and to remember the personal exemption thresholds. Remember we said the personal exemptions were repealed? Well, not for head of household filing status and not for your dependent. There is another credit that just came out. Other dependent credit for $500. So if that's not a qualified relative, you could have another dependent and it goes through that whole thing. Do they live with you? Do you pay more than 50% of their support? And so on. Does their income exceed the personal exemption threshold? Well, we said, wait a minute, they repealed that. No, they didn't repeal it for this. So the other dependent credit, ODC, of $500 dollar for dollar, you must use the personal exemption threshold of $4,050 going up to $4,100. So they're actually increasing the personal exemption, even though it's not in place. So they're calculating it for that specific provision. What about the kiddie tax? Have you heard a lot about that? And the reason why I bring it up is because now kiddie tax is on the estates and trust tax rates. Okay? So what you need to know is at least the 4 requirements. 1, the child does not file a joint return. 2, one or both of the child's parents are alive. 3, the child's net underincome, in this case, is more than $2,100 in 2018. And so then, more than likely, you will have a kiddie tax for this child. Now, it could go as early as age 17 to as late as age 23. The key is, if they don't make their own earned income, then they're more than likely, you're going to have a kiddie tax for them. As they go over the $2,100, and they go to $12,500. I don't know, a lot of people put, investments in the children's name. If they go over $12,500, they could pay a top tax rate of 37% and 20% capital gains. So you need to strategize. And you could strategize investment-wise as long as it's suitable for you. You could look at growth stocks, tax-efficient mutual funds, Series EE savings bonds, Section 529 plans, as we discussed. Coverdell, education savings accounts, life insurance products, etc. But the key is, have them go to work and make earnings that are subject to 50% or more of their living expenses. But guess what? They don't have to spend it. They could save it, and then they wouldn't be subject to the kiddie tax. So I like that strategy the best, them going to work. So that's just something I just wanted you to be aware that they lined up the kiddie tax with the estates and trust tax rates. Also, there's a paid family and medical leave credit, which means that in New York State, for example, 1/1/18, all employers must have a family paid leave policy in place. That's for your other employees. as of 1/1/18. It's sort of like your disability plan, and you pay $31.20. The employer contributes to it. Well, each of the employees contribute to it. Each of the employees must contribute to it. And New York State has a wage calculator for that. But you need to purchase the insurance. And then, if you purchase the insurance, you'll get a credit on the federal return in 2018 and 19. The employee must make less than $72,000, which is pretty favorable, and you will get the credit in those 2 years. You could go to the tax reform page of irs.gov. This just talks about switching from a S to a C, because everybody was questioning about whether we should switch and all that stuff. It's not really favorable if you're going to dissolve, liquidate, or close down, because then you have a 5-year waiting period when you elect to go from an S to a C. And after what I just presented to you, I don't think you need to do these elections and go crazy. As I told you, applicable financial statements affect the Tax Cuts and Jobs Act, especially for revenue recognition. Under Pub L number 115-97, the Tax Cuts and Jobs Act, they want you to align up with revenue recognition if you have applicable financial statement in place. As for your tax exempts, this is the key provision that you should be aware of. Nonprofits with multiple unrelated business activities are no longer allowed to offset income from a profitable business of another activity. They must have separate schedules. They want separate, unrelated business activity schedules and a separate schedule for your taxable fringe. That's in Notice 2018-67. You'll get a copy of the PowerPoint so you know where to refer to. And that's the impact. So again, we remind you, irs.gov says, do your payroll checkup, IRS/withholding. You can figure out whether, before the end of the year, how far away you are from all these changes that I went through that are going to affect your return. And one more thing that you could tell your clients, or even if you contribute to a health savings account, that's another way to reduce your income to a qualified business income, for the qualified business income deduction, and also obtain health insurance. That's for a high deductible plan, and what you're allowed to do is put the deductible in your health savings account, almost like an IRA, and use it for qualified expenses. If you don't use it, you could carry it forward and invest it. There was a problem with the Tax Cuts and Jobs Act. The family threshold was $6,900, announced in 2017. When the Tax Cuts and Jobs Act came out at the end of 2018, there was a different way they were increasing some of these thresholds, called chain CPI, and that decreased the allowable exemption. So many worried that if it decreased it by $50, am I going to get a penalty? And IRS put a notice out that we have a revenue procedure that's going to grant relief. So I just wanted you to be aware of that, and that comes in tax season when people start asking you about that stuff. And then finally, I don't know if this finally, but no, I want to go through the qualified opportunity zones before I end. I just want to remind you, foreign account reporting. As practitioners, you should have it on your organizers. The taxpayer should answer the questions on the Schedule B. Yes, I have a foreign account, or no, I don't have a foreign account. The definition being, do I have more than $10,000 at any time during the year? If I do, I say yes, and I tell them the country, and then I file an FBAR electronically, the same filing deadline. Because you don't want to have problems like in some of these cases that are on this slide, where eventually they find out and they take 50% of your account. And also they could withhold your passport. So let me get to a really popular area. In fact, I'm going to do a presentation next week with the Staten Island Economic Development Corporation on qualified opportunity zones and qualified opportunity funds. I don't know if you, if anyone of the accountants in this room have heard of it, but it came out of the Tax Cuts and Jobs Act. It covers 50 states. You could go onto irs.gov and actually look up by block and lot what those zones are. In Staten Island, it's mostly the Richmond Terrace area, going into Port Richmond and Mariners Harbor and St. George. The opportunity zone allows you to invest in economically distressed communities. But here's the key. You're allowed to invest capital gains from stocks. Okay? So if one of your clients has sold and has a high capital gain, you could defer that gain, invest it in the qualified opportunity funds. They could start their own fund, invest it in a qualified opportunity zone defined by the IRS, and you could do that within 180 days of the date of the sale on the 8949 shown realized gain. You report that you're deferring it. I'm putting it into a qualified opportunity fund. You start the qualified opportunity fund as a partnership or a corporation. If you're a partner or a subchapter S shareholder, you call up your partnership or your shareholder, the one that's monitoring the books and records. You go, are we going to have a gain flow through this year? And they say, yeah, you're going to have this much. Okay. Then the date is December 31st. You can start from the December 31st, look for a 180-day window, invest in a qualified opportunity fund that you set up or that is already set up. 90% or more of the assets must be in the qualified opportunity zone. The opportunity fund doesn't have to be in the zone, just the assets that it's holding. And you defer the gain. And till 2026, you then have to report and pay tax on the gain. But here's the key. If you hold it for 5 years, and do it as soon as possible, let's say this year, then you defer the gain, you get a 10% deferral, and then you hold it for another 2 years, you get a 15% deferral, and then in 2026, you report on only 80% of the gain, and some, talking with a tax attorney right now, who says, well, maybe we could do cash out refinancing, which means we could take money out of the entity to pay for the gain, okay? And then, if you hold it for 10 years, no cap gain, stepped up. Your basis is stepped up. So that's something that's on the horizon. There's a lot of people that are interested, mostly hedge funds, private equity firms. But it's a strategy that's out there for your clients. And if you're not mentioning it to them, I don't know, it's there. So there's 2 forms you should be aware of. The 8949, that allows you to recognize the gain and then report the fact that you're going into a qualified opportunity fund within the 180-day period. And then an 8996, which is a draft form to certify the qualified opportunity zone fund, the fund itself. And you must certify every year. And it's based on 90%, as I said. And also, the investment standard is when you put your capital gain in, you must invest twice the amount. Okay, that's at least what they want you to do. And if you have a qualified business opportunity zone business assets, you can do up to 70%. There's more details. You can go to the qualified opportunity zones. I just wanted to alert you because it's before December 31st, right? That you might find out that some of these clients have gains and might be interested in investing and deferring. This slide talks about the technical corrections we talked about, and AICPA is working with the IRS on getting these fixes implemented. So my final polling question is, see if you remember what I said. Compensation and benefits. What are the deductible rules for various meals? Taking a client to dinner. Anyone holler? 50%? Okay. Lunch and learn, 50%. Working dinner for employees, still 50%. Traveling, still 50% dinner. Traveling is 100% deductible as long as it's ordinary necessary. Office holiday parties off premises, 100%. Meals served in a luxury booth at the stadium, 0. Okay. You pass. Congratulations. Thank you for having me. Always remember to take a long-term view, as we say. Talk to your advisors. Keep an eye on Washington. Adjust your plans. And now we can start our Q&A as we transition to Brian.